Hello, everyone. I'm Finn. Welcome to the Finance from Zero channel, which means welcome to our journey of learning finance from scratch. If you are on this channel and in this video, it means you are taking your first steps in money management, investing, and financial literacy. And that is exactly why today we are diving deep into the most critical and most fundamental topic that everyone stepping into the world of finance must understand, which is the concept of interest. So, what is interest? Interest is the value money creates over time, or the act of renting out money. Just like when we let someone use our house or our car for a certain period and receive a rental payment in return, the same logic applies in the world of finance. When you give your money to the bank gets the right to use your money for a certain period, and in return for this period, it pays you a fee. This fee is the interest you earn. But when you borrow the bank's money as a loan or credit, you make an extra payment to the bank for the period you use that money, which means you pay the rent of the money, and this payment is the interest you pay. So interest is either the extra cost you pay when you borrow money, or the return you earn when your savings create value over time. But careful, interest is not a single type, and not every interest works the same way. In today's video, we will simply cover simple interest and compound interest and learn how to use these two fundamental types of interest to our advantage. Let's start with simple interest. As the name suggests, simple interest is straightforward and is calculated only on the principal amount, regardless of the time passed. For example, take this person who has $10,000. They see a yearly 10% simple interest advertisement from a bank and decide to invest their money in this bank for 3 years. So how much would they earn with simple interest? At the end of the first year, they earn $1,000. In the second year, again, $1,000. And because this amount is always calculated from the principal, they leave the bank with a total of $3,000 of profit at the end of the third year. So, do you know when this method is advantageous and when it is disadvantageous? Simple interest is advantageous for borrowing because the interest does not multiply by itself, and even if paid late, it does not grow exponentially. For example, you borrowed $100,000 with 10% simple interest. After 3 years, your debt becomes $100,000 plus 3 times $10,000 equals $130,000. Your debt does not choke you and does not grow uncontrollably. So, where is simple interest disadvantageous? It is not recommended for long-term investments because interest is always calculated from the principal and does not grow. The money cannot resist inflation and may lose value. As inflation increases, fixed return loses its real value. So in short, simple interest is useful for loans, but it carries weak return potential for long-term investments. Now let's move on to compound interest, the snowball effect. Compound interest is the calculation of interest on interest. It is one of the strongest tools in the financial world where money grows money. Here, interest is added not only to the principal, but also to the interest you already earned. So the total amount you get after 1 year becomes the new principal for the next year's interest. Let's use the same example. Our person again invests $10,000 in the bank at a yearly 10% interest, but this time with compound interest. In the first year, they earn $1,000 on $10,000. In the second year, interest is calculated on $11,000, and the second year's return becomes $1,100. At the end of 3 years, they withdraw their money from the bank with a total interest gain of $3,310. In short, simple interest is a straight line, compound interest is a flying curve. So what's the difference? With simple interest, you earned $3,000. Here you earn $3,310. That is only a $310 difference in 3 years. But what if it lasts 10 years? 20 years? 40 years? The snowball kicks in exactly at these moments. Let's take a look at the long-term effect of compound interest. $10,000 at 10% compound interest becomes $25,937 in 10 years, $67,000, $275 in 20 years, $174,494 in 30 years, and finally $452,593 in 40 years. The same money, the same interest rate. The only difference is time and the type of interest. Now you understand much better why Einstein said, "Compound interest is the eighth wonder of the world." So, where is compound interest advantageous? Long-term savings, retirement investments, child savings funds, portfolio investments, DeFi and crypto staking models based on automatic reinvestment. In any investment where you leave your money untouched for a long time, compound interest should always be preferred to protect and continuously grow its value against inflation and external factors. And where is compound interest dangerous? Don't borrow money with compound interest unless you're sure you can pay it back. Let's return to our example. You applied to a bank to open a business and faced two options: $50,000 with a fixed interest rate or $100,000 with 3% monthly compound interest. You were sure the business would quickly take off and you could pay off the debt, but unfortunately the business did not do well and you couldn't pay it off immediately. After 1 month, your debt became $103,000. After 6 months, $119,000. And after 12 months, $142,000. If you never pay anything, your debt grows $42,000 in a single year, and worst of all, it will keep growing like this. And here's the final summary. Use the right interest in the right place. Simple interest, good for borrowing, reasonable in the short term, but loses against inflation in the long term. Compound interest, excellent for investing, creates rocket effect in the long term, dangerous for borrowing. The rule is clear. If you make interest work for you, you win. If interest works against you, you lose. Of course, interest does not consist only of simple and compound interest. It can also be divided into effective interest, nominal interest, fixed interest, variable interest. Well, they will be part of the next videos. Today we covered the basics of the interest concept, the differences between simple and compound interest, and which one is more logical in which situation, all explained in detail and in a language simple enough for beginners to understand. In the next videos, we will move on to the fundamentals of investing, risk management, and how you can grow your money in the long term. If you find my videos helpful, subscribe and write any video ideas you want me to cover in the comments. We continue learning finance from zero together. For now, that's it from me. I am Finn, and you've been watching Finance from Zero.